Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, January 29, 2015. Looking at a daily chart of the SPY. And remember these two blue lines from last night. I said this was pretty much the line in the sand, and the market would have to defend this trend line, at worst case this trend line, and I said if we didn't hold this trend line here, for sure I thought we would go down into this area. But guess what? Look what kind of a hit this market made on the trend line that not that I drew, that the market drew in. Okay, the market drew this in based on this low here. Okay, once you have two pivots, you can draw a trend line, and that's what we did. And guess what? The market came right into the trend line, pierced through just by a hair, and then reversed higher and went pretty much strong all day long once we hit that trend line. Pretty interesting stuff. I got to tell you, the market draws these trend lines in for traders. And when I say that, what I mean by that is, I'm not the only one that knows how to draw a trend line, right? There's plenty of people out there that know how to draw a trend line. So the more people that are drawing a trend line like this, okay, that the market is essentially drawing in for us. But once you get to this third hit here and people have this trend line on their charts and they're saying, all right, I'm going to take a shot at the market when we hit this trend line. If we start to bounce off this trend line, I'm going to go long. And anybody that drew this trend line in had the same kind of philosophy today, and knowing that once the market bounced off that trend line, we went higher. And because buying begets buying, short covering kicks in, and it just perpetuates all day long. And that's exactly what happened today. So most of my work, as you know, is done on the E-mini contract. And yesterday I told you that my downside target, because we overshot the 1997 by like 9 or 10 points yesterday, what I thought would happen was we would go down and we would hit the 1977 number, which was my next target. But what happened was we hit 1982, missed it by 5 points, and basically rallied all day long. And that 1982 on the E-mini coincides with this trend line here in the SPY. So thought I'd just make mention of that. And what happens is when a market misses a target by that much, okay, and it starts to reverse, that is telling you that there's plenty of bullishness, in this case, going underneath the market, and there's a bid underneath the market. When it can't get to the target, there's too much of a bid underneath the market. And the same thing goes on the flip side. When the target is on the upside and you can't get there, the market is weak and your reversal should be harder. And that's what we saw today. We saw the reversal was much stronger on the upside because we didn't get to the target. At least that's I see that time and time again. When the market doesn't hit my targets, it tends to go the other way in rapid fashion. So, the last component of the stock market for this week was we were looking for a low the latter part of this week. From the turn between Thursday and Friday of last week, we were looking for a turn. We were looking for a downturn to culminate the latter part of this week. Well, guess what? We may have seen it today. This would qualify as the latter part of this week, Thursday. And we'll see what tomorrow brings. So what does tomorrow bring? Well, let's look at the intraday chart, because I think you'll get a decent picture of one of the scenarios that I think could play out. I think this has, more than a 50% probability of playing out. So let's say tomorrow we begin to get a pullback in the morning, okay? And if we get a pullback for whatever the reason they want to pin on the market, this is a 10-minute chart. This is the low today, okay? This is down at 198.68, all right? And this is the high today. And this 382 retrace is down here. We're just going to call it $201. It's a little bit below that, but it's $201, okay? But you have the 50-period moving average sloping up. Okay, so that's why I say it's really $201, because you would normally stop at the 50 if we're going to get down this far tomorrow, but I don't even think we have to get down that far. I think your first target would be this pivot high here at about 201.44, 201.50, in that neighborhood. And then if you did continue lower, if the market was going down, maybe you get to 201 in that neighborhood. And I think that would be the extent of it. And while this looks like a big pullback, remember, this is a 10-minute chart, so it's not a big pullback. You know, if you go to the daily chart, okay? Where's 201? Okay, let's move this over. 201 is right here. Okay, so, to retrace a third of the rally from today is certainly plausible, not out of the question. And if the market had a bid underneath it and it was light volume and it wasn't scaling down for some, reason that came out overnight, or Europe or geopolitical or some nonsense, then it would most likely just work off some of the, intraday overbought condition, and then pull back maybe 25 to 30% of that move from today. And then next week we could look for higher prices, because remember, this was a weekly bottom in my cycle analysis. And if this is a weekly bottom and this bottom holds, which it held today, okay, if this bottom's hold, that's bullish for the market, and you can have another couple of weeks of upside here, and we can certainly make new highs. That is most probable if we get some follow through from this. Obviously, we'll have to get through this level here, but if we get some follow through from today over the next couple of days into next week, you're going to look for higher prices. All right. Let's move on, because we got some other good stuff going on. Gold. Let's talk about the GLD. Now, yesterday I said that if the spot gold price, gold futures, April contract was to close hourly and then daily, and multiple hours equal a day, obviously, over 1277, okay, then I thought we would take another run at 1300. But that didn't happen. The market went all the way down to 1250. I'm not sure. I want to say 1252, something like that. And now we're up a little bit in the aftermarket session. In the Globex session, we're up at 1260. But so I think that there's always two possibilities. There's always 100 possibilities. But the two highest probability scenarios are this in the gold market. One is the 1250 was the retest we were looking for, the 200 period moving average we were looking for that I was talking to you about. What did we do? Came right into this gap window here and reversed. Isn't that ironic? How many times did I tell you that this 200 period moving average gap window and this pivot high was going to be support? And guess what? So far, that was support. Now, I don't know if this is going to hold. And if it holds and we go back up, I don't think we can bust through these highs. But if it doesn't hold, I think you can come down to, this 50 period moving average, which is a little ways down from here. So that'll scare a lot of the weak hands out of the market. But we'll see how this 200 period moving average holds. But I know at least 3 or 4 times I told you that this was a solid level. I mean, if you're sitting in front of the computer and you're watching GLD today and you see GLD come into this area right here, okay, this pivot high, this gap window just broke the 200 period moving average, okay, and you're not a buyer here, then you're in the wrong business. This is the risk business when the odds are on your side. This isn't blackjack, right? We're not guessing that the hold card is a 10. This is, the probabilities are in your favor when you see setups like this. Pivot high, gap window, just broke the 200 period moving average. What else are you looking for in order to take a trade, right? So if you're an intraday type of trader at minimum, okay, you're long at this level here at 120.30, 120.35, okay, and you finish the day, where'd you close today? 120.86. Okay, I mean, just intraday alone, that's a nice little trade. Okay, so I know I gave you that level like 3 times. Crude oil, this is a good one. All right, I'm going to bring up the USO, but we're not going to talk about the USO. We're going to talk about crude oil. So the USO, I don't know what you call this, but this is a little tiny tail, but it's not what we're looking for. It's not even close. But here's the deal. Okay, the deal is this. Last night I told you 43.70 was my number, okay? And today we went down to 43.52, all right? Or 58, one of the two, I forgot. Anyway, and then we reversed. And right now, crude oil is trading at about 44.5. Now, and here's the kicker, okay? I don't know if that was the bottom, but that was certainly a number. That was a square out number that I calculated, and it may hold. It may hold for a while. It's not going to hold long term, I don't think, but it'll hold for a while. And if it does, okay, what we have to see from here is we have to see the market continue to close above today's low. So here's what you can do if you're an aggressive trader, right? An aggressive trader would do something like this. He would buy the crude oil market and put a close or a stop below today's low as a closeout. And that's one way to play trying to pick a bottom. And I'm not suggesting you try and pick a bottom, but here's how you should play it. Now, aggressive traders play it the other way. Here's how you should play it. You should wait for a high volume up day. You know, you're going to give away $1.50, maybe even $2 on the upside. But when you see that day, that's going to tell you the market put in a bottom. Now, here's the kicker. All right, let's move right on to the dollar. I don't talk about the dollar much, but I have an indication for the dollar, so I want to mention it, and it ties back into crude and maybe gold. So watch this, or just listen to this. Well, I'm going to bring up the UUP. Okay, I have an indication that if we begin closing the day, for example, starting tomorrow, if we begin closing tomorrow a 95.25 in the US dollar. We're trading at 94.82 right now. So as long as we close the day tomorrow below 95.25, okay, and then, you know, we start to close hourly below there on Monday, okay, you're going to look for, let me check my notes here, you're going to look for, okay, you're going to look for a move all the way down in the US dollar, down into the 93.25 area, or maybe even lower down to 93.10. Okay, so what does that mean in terms of what we can visualize? Okay, so I'm looking at a dollar chart on another screen, and I'm just getting the level for you, and then I'm going to translate it to the UUP. Okay, here it is. Okay, here's your level on the UUP. Okay, well, let's just, for safety, we'll say that you could see a move. Well, that's not all that big of a move. Yeah, the UUP doesn't move that much, but a move down from, you know, almost just under 95 to 93 in the US dollar, that's a big move. Okay, in the UUP, it doesn't seem like much. Well, I guess it is, because it does move pennies. So it would be a almost a 40-cent move. You're looking for 35 to 40 cents in the UUP. Actually, that is a pretty good move in the UUP, considering, you know, it doesn't move all that much. And I'm talking about quickly. I'm talking about, you know, into early next week, into like Tuesday on the outside, Wednesday, if it's going to happen at all. And what you do is your stop is a close above 95.25 in the US dollar, right? If we close above 95.25, it's not going to look like the trade is going to work out. But if we close below 95.25, it looks like the low 93s are in the cards on the US dollar. So that's on the March contract. So hopefully that'll be helpful. But the point I'm bringing up here, by the way, and I want to tie it back into oil. You know, one of the reasons oil is going down is because the dollar's moving up, and every currency or every purchaser who's purchasing oil in a foreign currency has to convert to the dollars. If the dollar continues to get stronger, their currency's weakening against the dollar. Therefore, it's costing them more to convert and to buy the oil. That's why the price of oil goes down. Okay, because it costs more to buy it. So it's a simple economics, supply and demand, and all that, economics 101. So what's happening is if the dollar has a dramatic, sharp pullback for a couple of days, you could see a pop in oil, and you may even see some follow through in gold on the upside, although gold's been moving up with the dollar, so I'm not thinking it's going to be linked on the downside like oil should be linked. If the dollar moves down, I would expect oil to pop, and that ties in to the low, the 43.70 or really 43.52 or 58 that we saw today. And if that holds, and next week we get the sell-off in the dollar, we may get the pop in oil, and that may put in the bottom. That may be the sign of the bottom. This is a lot of what ifs, but I can see this trade lining up. I see what my indication in the dollar is giving me, and I'm tying it back to oil, and it just looks like that could be the low we're looking for in oil. we're going to see how it plays out. I'll talk about it tomorrow night again, and we'll talk about it till it either happens or doesn't happen. So this was a long enough video. Hopefully it's helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.